Hello there, my name is Patrick Kamau Kamure, your teacher for advanced taxation. I welcome you today to today's lesson where we continue learning about the taxation of the businesses. We said that the areas that we need to look at from the start are the taxation of the two businesses, that is the taxation of the partnership and the taxation of the limited company. Now, we started with the taxation of the partnership, where we said that there are two areas that we needed to cover. One of them is the admission and retirement of a partner during the year. That is already covered. And then the conversion of a partnership into a limited company, which we also covered. So now we go to the next business, which is the taxation of the limited company. Now here we are, taxation of the limited company. Now, in the taxation of the limited company at this advanced level, there are several areas that we need to look at. So I'll list the areas here, and then we'll go through them one by one. So the areas to be covered. So these are the areas that we are going to be looking at. The first one is the corporation tax. When you talk of the corporation tax, it refers to the tax that is usually supposed to be paid by a limited company. How do you normally determine it? Another one we go to is the installment tax. We go to the taxation of the group of companies. We go to the taxation of companies. And when you talk of specialized companies, these are companies which have specialized in a given area. And as you can see them here, like a bank, those that are in banking, the insurance companies, we have construction companies, cooperative societies, we have air and sea transport companies, among others. Like we are also going to look at the petroleum companies and among others that are going to be under the specialized company. There are several, like around 12 of them. So in that case, this will be covered under the specialized company. After we are done with that, we are going to go to the shortfall distribution tax. And the last area would be the compensating tax. So once we cover all this, then the taxation of the company is going to be complete. So we are going to start with the first one, the corporation tax. So what do you need to know about the corporation tax, or the tax that is usually payable by the limited company? This is what you need to know. Number one, so these are the points that you need to know when you're determining the corporation tax of a limited company. Number one, when you talk of the corporation tax, this is the tax that is usually payable by a limited company. Company's tax. That's why we call it your corporation tax. Another thing is that limited companies are taxed on the taxable income. So you have to determine the taxable income, just like any other business, so that you can go ahead and tax and now determine the tax to be paid by that company. But how do you determine the taxable income? As we said from the word go, that whenever you want to determine the taxable income of any business, you either use the net profit method or the gross profit method. So it is the same case with the limited company. So if you're given the net accounting profit, then you use the net profit method. If no net accounting profit is provided, then you use the gross profit method. Point number 3. Once the taxable income is determined, it is taxed on the company itself, because the company is a separate legal entity from the owners or shareholders, and it is taxed at the following rates. So in that case, you noted when you are looking at the taxation of the partnership, we said that once you determine the taxable income of the partnership, you normally distribute to the partners. So the partners are the one who normally bear the tax burden of the partnership business, because we said there is no separation of the partnership and the partners. So the partners and the partnership are one and the same thing. Determine the taxable income, give it to the partners, tax the partners themselves. But here, company is a separate legal entity, meaning the owners and the company are two different entity. So you determine the taxable income of the company, don't tax it on the owners, don't tax it on the shareholder, tax it on the company itself. So how do you tax it on the company? We are saying it depends on these points. One, if it's a resident company, then you tax it at the corporation tax rate of 30%. So you determine the taxable income using one of these, apply 30%. But there was a time that you'd always note that the tax rate was not 30% in the year 2020. And it's because of COVID effect where the government reduced the tax rate for the resident company from 30% to 25%. So that is one of the things that you need to note. Another one or another rate that we have is for non-resident companies where the corporation tax rate is 37.5%. So you need to determine the taxable income, then apply there if you are told it's a foreign company or a non-resident company. Then there's another one for companies located at the export processing zone, also called EPZ. Now, these are the areas which the government has set aside for the companies to be established there. And when company is established there, it can only manufacture goods for exports. So only goods for exports. So to try to encourage companies to go and set up their activities there so that they can manufacture more for export. You see, the government normally benefit, or a country normally benefit more when we export than when we import. So to encourage more export, these areas enjoy the following favorable terms. One, tax holiday for the first 10 years of their operation. So if you go set up your company there and it must be for exports only, then for 10 years you don't pay any single coin to the government in form of tax. Then we have number two, lower tax rate of 25% from the 11th year of the operation. So instead of the normal 30%, you only pay 25%. So there is a saving of 5%. And then their purchases are usually zero rated. This we are going to see when we do the VAT. We are going to learn that supplies to the export processing zone entities are usually zero rated. That will mean that even if something was chargeable VAT, don't charge it. Charge it at 0% when you supply to export processing zone. So that means that they don't pay VAT generally. That was the point number 3 that you need to know when you are determining the corporation tax. Point number 4 that you need to know when you're determining the corporation tax is what we call additional allowable expenses for the limited company. Now, when you talk of the additional, we are talking about, you see, before we got here, we had already looked at the taxable income of the business, non-taxable incomes, allowable and non-allowable expense of the business, the general business, whether it is a partnership business, a sole proprietorship business, or a limited company. However, now when you narrow down to the limited company, there are those expenses that you only find in the limited company, and they are usually allowable. So these are the ones. So one of them we have said is the payment to the directors of the company for the service rendered. Directors are usually considered to the employees of the company. So if they render the service in any way and they are paid for that, that is supposed to be an allowable expense. And you'll find it being mentioned like director's fee, director commission, director salary, any, as long as it's for the service rendered, that is supposed to be an allowable expense. Another one is interest on debentures. Now, debentures are usually a form of loan to a company, and only a company can issue debentures. So a partnership, a sole proprietorship cannot issue the debentures. So this is for the reserve of the limited company. So the interest that is usually paid for that loan, which we are calling the debentures, is supposed to be an allowable expense. Also, we have the cost of issuing shares, or flotation cost of shares, or cost of listing at the stock exchange market. So any cost that a company gets in order to issue the shares, that is supposed to be allowable. Others are like, for some companies have to be listed at Nairobi Stock Exchange Market, for example, for their shares to be exchanged there, to be listed there. So the cost of getting there is supposed to be an allowable expense. So that is supposed to be point number 4, additional allowable expenses. After that, we have point number 5 that you need to know when you're determining the corporation tax, what we call additional non-allowable expenses. These are the expenses of a company, specifically for the company, and they're usually not allowable. So what are those ones? One is any form of dividend. Any form of dividend in terms of, for example, proposed dividends, paid dividends, interim dividend. If you find any dividend in a limited company, don't allow. And why don't we allow? Because when you are looking at the generally non-allowable expenses of any business, we said any payment to the owner of the business is usually not allowable. In the company, we call it the dividend. So we don't allow because it is paid to the owners or to the shareholders. The last one is of the additional non-allowable expense is the all reserves. Reserve is the money set aside for future use. So we don't allow that expense until that time comes when that expense is incurred. For example, for a company that know that next year they are going to incur some rent expense. Next year, they're going to incur some electricity expense. They may set aside some money. When that time comes, they use it to pay for that expense. We don't allow until that time comes. So that is what you need to know about the corporation tax. And at that moment, we should look at a question concerning what we have learned. However, corporation tax is usually not alone. It normally comes together with what we call installment tax. So we must look at the installment tax and then we look at the question. So what is this installment tax? So we should have this was number 1. We have number 2. We have installment tax. So these are the points that you need to get when you are talking about the installment tax. So we have point number 1. So that is the first point that you need to know, that installment tax is not an additional tax, but a way in which the company pay the current year tax, corporation tax during the current year in installments. What does that mean? This is what it means. You see, for a company which can start the year, for example, on 1st of January 2021, it means the year will end on that 1st of December 2021. A company has to operate the whole of the year, get to the end of the year, determine the taxable income of that particular year. If you find that the taxable income is like 100 million, the company will be required to determine the corporation tax. And we have seen, for example, if it is a resident company, then the corporation tax will be 30% of the taxable income. That means that the company is supposed to pay that million. That is the corporation tax, which is now the actual tax. But according to the Income Tax Act, that company is supposed to have paid that tax during this year as it was operating. So how was it supposed to be paid? It was supposed to be paid in installment. But now the question is, how can you tell a company to be paying that year tax during that year in installment? Whereas it has to get to the end of the year, determine the taxable income and the tax is supposed to pay. So this is supposed to be done at the start of the year, where the company do an estimation of the tax that they are supposed to pay in that particular year. Then they pay it in installments. So I want us to see how that estimation is usually done, and then once it is done, how it is paid. So this is how we estimate that tax, which you have said is done at the beginning of the year. For an ongoing company, that means that the company started operation a long time ago, we take 110% of the previous year tax. For example, what I had indicated here, it was the year 2021. The previous year was 2020. The company was still in operation. So we take the tax that was paid in 2020, and then we take 110% of it. So if in 2020, the company paid 10 million, so we take 110% of 10 million. That gives you 11 million. So that becomes now the estimation of the tax for that year that need to be paid in installment. For a starting company, for example, for that company that started on 1st of January 2021, it doesn't have the previous year where it can take 110%. So it normally do what we call budgeted tax. So it has to determine how much is the tax it's supposed to pay in that particular year. And how do they determine the budget tax? They use the budgeted taxable income. You see, once the company prepare the budgeted income statement, we can adjust it to get the budgeted taxable income. And from the budgeted taxable income, we multiply by the corporation tax rate to give us the budget tax is supposed to pay. So once that is done, then it is paid in that particular year. Point number 3. So the payment of the installment tax once it is estimated at the beginning of the period usually depend on whether we are talking about an agricultural company or agricultural company. A non-agricultural company, these are companies that do not do farming. So we are talking about any other company that other than those that are in farming. For example, a bank, an insurance company, a transport company, and any other that is not in farming. So we are going to see how it normally make the payment of the installment tax. The other one is an agricultural company. These are companies that do farming. So how do they pay their installment tax? I want to illustrate for each one of them. So we start with number one. Okay, so we are looking at the payment of the installment tax, and we say the payment is dependent on whether it's an agricultural company or an agricultural company. And we say an agricultural are all other companies other than those that do farming. So once we have estimated the installment tax using either here or this one, this is how it is paid. We have the installment, the amount payable, and when it is due. And we have the first installment where we take 25% of the total installment. For example, as I had mentioned, we estimated that the installment is supposed to be 11 million based on 110% of previous tax of 10 million. So 110 of 10 million, that is 11 million. So you take 25% of 11 million and then you pay by 20th of the fourth month in the year of income. So in that year, so if it is the year 2021, you pay by 20th of April 2021. And then we have the second installment, another 25% of the total installment. What you have estimated, the 11 million, and you pay by 20th of the sixth month in the year of income. So if the year of income starts January, that means that by 20th June 2021, you pay the second installment. Then we have the third installment, another 25% of the total installment. So 25% of 11 million, and you pay by 20th of the 9th month. So if your year of income starts January, we are talking about September 20th. In that year of income, you pay the third installment. Then the fourth installment, another 25% of the total installment of the 11 million we talked about, and you pay by 20th of the 12th month in the year of income. Now, you note that by the time you pay the fourth installment, you would have paid 100% of the total installment because you had paid first installment 25, second 25, third 25, fourth 25. You add these percentages, you get 100%. So by the time you pay the fourth installment, you have paid 100% of the whole installment, 11 million. Now, by that time, you can see here, we are talking about 20th of the 12th month. You are around, if the year of income starts January, that means that it ends on 31st December. So it means that you are around 11 days to the end of the year. So now you will get to the end of the year where now you determine the actual taxable income. Like I had mentioned, the actual taxable income of the illustration I had given was 100 million. So you multiply by 30%, you get the tax that you're supposed to pay is 30 million. So now you determine that I was not actually supposed to pay 11 million as I paid through installment. I'm actually supposed to pay 30 million, where now you'll be required by the government to make the final payment. We call it final tax, and this is based on actual tax. So how do you get the final tax? Final tax is as a result of taking the actual tax, like we have said, the actual tax is 30 million, minus the total installment you have paid, the 11 million. So the difference is 19 million. So that is now how much you owe to the government by the end of the year. When are you supposed to pay it? By 30th of the fourth month after the year of income. So if the year of income ended on 31st December, so that means that 30th April 2022, you are supposed to make this final payment. And sometimes here you are saying that, we are talking about the final tax that you're supposed to pay. It can also be a refund, whereby if the actual tax is less than the installment you have paid, like we said, installment tax that we had estimated was 11 million. How about in case you get the actual tax is 8 million? So it means that you have paid more through installment, the 11 million, than you are actually supposed to pay, the 8 million. There is a difference of 3 million. That 3 million become the refund, not to be paid. That is for non-agricultural companies. How about the agricultural companies? This is how the installment tax is paid. So that is for agricultural companies. That is how they pay their installment tax. And if you compare with an agricultural company, you find that there is no much difference. Actually, the only difference is that for agricultural company, instead of paying the first installment of 25 and the second one and the third, they are combined and paid where we were paying the third installment for an agricultural company. So we add the three so that the first installment becomes 25% of total installment you had estimated, and you pay by 20th of the 9th month in the year of income. Now, once you pay the 75%, that means that there is 25% remaining. So that 25% becomes the second installment, and you pay by 20th of the 12th month in the year of income. Now, after that, just like we said here, you'll be required when you get to the end of the year, determine the actual tax that you're supposed to pay, and now you pay the final tax. Final tax is supposed to be the actual tax for the year minus the installment that you have paid. So the difference you pay by 30th of the 4th month after the year of income. So that is how we normally pay the installment tax. So for these two, the corporation tax and installment tax is done. So we are supposed to look at a question before now we continue with the group of companies and other areas. So we look at a question.